All right, so we're diving into financial markets today. And wow, you weren't kidding with all this info. Looks like you've been digging into everything from the basics to some pretty in-depth stuff. So ready to get a grip on how it all actually works.
Absolutely, and it's great to be here to break it all down. You see, at their heart, financial markets are all about connecting the dots. They're the link between those who have capital ready to invest and those who need it to fuel their ideas and projects.
Okay, I like that, connecting the dots. It makes it seem less, I don't know, intimidating. But what does that look like in real life? We always hear about the stock market, but your research mentioned other types of markets too, right?
Exactly. When a company issues stocks, they're tapping into the capital markets. That's just one piece of the puzzle. You've also got money markets, which deal with shorter-term loans and debt. Think things that mature within a year, very fast-paced. And of course, no discussion would be complete without mentioning the foreign exchange market, Forex for short, where currencies get traded constantly.
Forex, right. That one always seemed kind of mysterious. Like, I get the idea of exchanging currency if I travel, but trading it. Anyway, there was also something in the beginner's guide you sent about derivatives. Sounded really complex, something about contracts based on other assets.
It's actually simpler than it sounds. Think about a mortgage, for instance. That's a derivative.
Really?
Yep. It's tied to the house, the underlying asset. So derivatives are basically contracts that get their value from how another asset performs.
Huh, never thought of a mortgage like that. It's like this whole hidden layer of the market most of us don't even realize we're a part of.
Exactly. And your research even mentioned how some companies use them to manage risk. Like, remember Company X and how they hedge against fluctuating oil prices?
Yeah.
That's them using derivatives strategically.
Right. Okay, so that's the what, the different types of markets. But what about the why? Why should someone care about how these markets even function?
Now that's the million-dollar question. Financial markets have these crucial roles. They're the mechanism for price discovery, which basically means figuring out what things are actually worth. They provide liquidity, meaning how easily you can buy or sell something. And importantly, they're key for capital formation, which is essential for, well, everything to grow.
So it's like this constant dance between what people want, what it's worth, and who's willing to take the risk. And this is happening globally, right?
You got it. And understanding those steps, that's what lets you navigate this world effectively. Which brings us to the exciting part, how you can get involved through trading. So we're talking about actually getting involved in the markets, which often means trading. But first, we should clarify, right? Investors and traders, they're both in the game, but with different playbooks. Investors are thinking long-term, playing the long game. Traders, they're all about those short-term price swings, trying to ride those waves.
Okay, yeah, that's a good way to put it. Like planting a tree and watching it grow versus, I don't know, surfing. You need different skills and strategies for those.
Exactly. And just like there are different types of waves to surf, there are a bunch of trading styles out there. Your research mentioned day trading, which is like the most intense version, right? Opening and closing positions all in one trading day. But then you've got swing trading, holding a bit longer, maybe days or weeks, to catch those price swings.
I'll be honest, even thinking about day trading makes my stomach churn a bit. Sounds like you need nerves of steel for that.
It's funny you say that. A lot of people think it's all about being super fast, but really, the successful day traders will tell you it's more about discipline and really understanding the mechanics. It's strategy, risk management, not just gut feeling.
So not just like frantically hitting buy and sell based on a hunch, which actually reminds me, something that always confused me, all those different order types. I saw stuff about market orders and limit orders. Any chance we could clear that up?
Of course. So imagine you see a stock and you're like, I need to buy this right now at this price. That's a market order. It gets executed immediately, but you're not guaranteed that exact price. Then you've got limit orders, which are more like, okay, I'll buy, but only at this price or better.
Right. So market order is like, give me the best price now. And limit order is, this is my line in the sand.
Exactly. And then there are stop orders, which are like your safety net. Let's say you buy a stock at $50, but you want to limit your risk. You set a stop loss order at, say, $45. If the price drops to that, boom, your order automatically becomes a market order, selling it off to prevent even bigger losses.
Okay, that makes sense. It's like putting a financial guardrail in place. I also saw something about a trailing stop order in my research, but that one went over my head a bit.
The trailing stop, that one's a bit more dynamic. Think of it like a stop loss that follows the price as it climbs. So let's say you set a trailing stop 10% below the market price. As the price goes up, your stop order trails behind it. But if it suddenly drops by 10%, your position gets automatically sold.
So you're essentially riding the wave, but with a safety net in case it breaks. Pretty smart.
You got it. Now, speaking of ways to, let's say, amplify your gains and potential losses, we need to talk about leverage. Powerful tool, but you really need to understand how it works.
Leverage, right. Always seemed a bit mysterious and maybe a tad dangerous.
Well, you're not wrong. Basically, it lets you control a bigger position than your actual money would normally allow. Think of it like using a lever to lift a heavy object. You're amplifying your strength, so to speak.
So instead of just trading with the money I have, leverage is like borrowing extra funds to make bigger moves.
Exactly. It's like being able to buy an entire share of a company by just putting down a fraction of the cost. But here's the catch. Leverage magnifies everything, profits and losses.
Right, that makes sense. Higher risk, higher reward, or however that saying goes. But is there any way to actually manage that risk when you're using leverage?
Absolutely. Stop loss orders, remember those? Those are your friend.
Yeah.
And crucially, never, ever leverage more than you can stomach losing.
Solid advice. And speaking of things that can influence our trading, sometimes our own emotions are the riskiest factor of all, right?
Oh, absolutely. Talk to any trader, even the seasoned pros. They'll tell you emotions can cloud your judgment and lead to some costly mistakes.
Isn't that the truth? We've all been there, right? Getting caught up in the hype of a potential win, or letting that fear creep in when things take a dip. My research mentions something called loss aversion, which I think ties into that. What's that all about?
Loss aversion is interesting. It's like this quirk of how our brains work. Basically, it means that the feeling of losing, say, $100 hits us harder than the joy of finding $100.
Oh, tell me about it. I'm definitely guilty of that. Seems pretty human, actually.
But how does knowing that help us make better decisions when it comes to investing?
Awareness is key, right? Once you know you're wired that way, you can catch yourself. Like, instead of freaking out and selling everything the second a stock dips, you can take a breath. Think about the bigger picture, those long-term goals you set. Right, don't let your emotions make the decisions for you.
Exactly. And that circles back to having a solid strategy, which is basically your roadmap for investing, especially when things get bumpy.
Speaking of roadmaps, let's say someone's ready to dive in. Where do they even start? We talked about all those different markets, stocks, Forex, commodities. It can be a lot.
No doubt, it's easy to get overwhelmed. Honestly, a good place to begin is think about what you actually find interesting. Passionate about tech. Maybe digging into tech stocks is your thing. Follow global events closely. Forex might be up your alley, analyzing currencies and all that.
So it's not just about chasing the latest hot stock tip. It's about actually finding something that you connect with.
100%.
Yeah.
You're more likely to put in the time, the research, if you're actually invested in the topic. Don't forget about risk tolerance either. Your research touched upon that, and it's a biggie. Are you someone who can handle those big swings, or do you prefer something a bit more, stable?
Right, because not all investments are created equal when it comes to that risk factor.
Yeah.
Exactly. Once you've got a feel for how much risk you're comfortable with, then you can start exploring different strategies. Some people are all about that active trading life, constantly buying and selling, trying to beat the market. Others prefer a more hands-off approach, maybe investing in index funds that track a certain part of the market.
So really no right or wrong way to do it. Just depends on what fits your life and goals.
Exactly. The bottom line is, do your homework, understand what's at stake, and never invest more than you can afford to lose. Simple as that. And remember, this world, finance, it's always changing, always something new to learn.
It's been awesome taking this deep dive with you. Hopefully our listeners are walking away feeling empowered, maybe even a bit inspired to learn more.
Definitely. And remember, when it comes to finance, knowledge is power.
So as you continue to explore the world of financial markets, what's got you curious? What questions are you going to tackle next in your research? Until next time, happy investing, everyone.